little devil or angel. um, I keep like we have an hour allotted with our brilliant minds. And before I introduce our moderator, Education Chair Wayne Yuen, I wanted to take a moment to ask that if you currently have videos, go ahead and disable it for now for the first part of our discussion. We're going to save a little bit on bandwidth, and the plan is that Steve, Nick, Tim, and Apollo will be fielding your questions that you pre-submitted upon registration. And if we have time at the end, we will address any questions that come up during the discussion. So if you have them, go ahead and put those in the chat as they arise, and I'll be monitoring the chat for those. So with that said, I wanted to welcome Wayne Yuen, our moderator for this afternoon. Wayne's the Education Chair for the FPA of Georgia, and in addition to the outstanding work he has done this year to help us to pivot to a webinar format so that we can continue to provide meaningful and educational content to our members, Wayne is also a regional sales manager in the U.S. Intermediaries Financial Institutions Group at T. Rowe Price, where he covers registered investment advisors and bank trust relationships in the Southeast region. Wayne's mission is to help a diverse group of financial professionals elevate their businesses to higher levels. So it's kind of like what he's helping us do today. Thank you for joining us today, Wayne, and I'll let you introduce our esteemed group. Thank you.
Thank you so much, Kristen. I appreciate the kind intro. And more importantly, my job today is to moderate this fantastic panel. So thank you, gentlemen, for sharing some of your time with us. And thank you also to all of the members who have joined us today on a Friday at 4:30. We definitely appreciate your time. And we're hoping for an engaging conversation where you're able to take away some tidbits that you learn more about these organizations, and some of the questions that you submitted, you'll be able to get those answered as well. So first, I'm going to introduce our friends and colleagues from Vanguard, and then I'm going to introduce our friends and colleagues from Dimensional Funds, and then we'll start this sort of conversation. It's more of a fireside chat. Of course, as Kristen mentioned, if you have questions that you want to ask live, we're going to save some time at the end for that as well. So let's get started. I'm going to introduce Steve. Steve Simons is a RIA sales executive in Vanguard's Financial Advisor Services division. He joined Vanguard in 2011 to work with registered investment advisors in Georgia, Alabama, and the Carolinas. He started his career in investment management in 2002, holding positions at Goldman Sachs, Merrill Lynch Investment Managers, and Invesco prior to Vanguard. We also are joined by Nick Macrina, who is a CFA, a senior portfolio specialist with Vanguard's Financial Advisor Services division, where he consults with advisors on investment thought leadership and Vanguard's full range of investment solutions. Prior to Vanguard, Nick held various roles at BlackRock. Nick began his career at BlackRock in the U.S. Wealth Advisory Group, its intermediary driven distribution team, primarily as an internal wholesaler covering clients in Mid-Atlantic region. We also have from Dimensional Funds, we're joined by Tim Whalen. Tim consults with advisors on portfolio construction, updates advisors on capital markets research, and assists them with client communication. Additionally, he educates advisors and prospects on Dimensional's investment philosophy and how the firm can help them build a successful fee-based advisory business. Before joining DFA, Tim was an ETF consultant at Deutsche Asset Management and an iShare ETF investment management consultant at BlackRock. Last but not least, I save one of the best, Dr. Apollo Lupescu is a vice president at Dimensional Funds, where he started in 2004 after finishing his PhD in economics and finance at the University of California, Santa Barbara. During his tenure at the firm, he's gained experience in a wide variety of practical subject matters. He's part of Dimensional's investment strategy group, working directly with financial advisors in the Northeast area to assist in development of their business, managed an internal client services team, and oversaw the firm's national advisor retirement business. The joke I've heard from folks that know him and have heard him speak is that he's known as the secretary of explaining stuff, which I think is appropriate from what I've heard and what I've seen myself. So with that being said, we'd like to sort of jump in, considering we don't have that much time, and we want to make sure we're using your time in the best possible manner. One of the first questions that was proposed, and I'm gonna throw this to Steve to start, kick us off, is can you give us a brief history of your firm?
Absolutely, and thank you, Wayne, for having us. Thanks, Chris, and thanks to all of our FPA constituents joining us, and certainly Tim and Apollo. Thank you, guys, for being open to doing this. This will be a lot of fun. So a quick history, I'll do it in, call it 90 seconds or less, if that's good, Wayne. So many of you may know Vanguard was founded in 1975 by Mr. Jack Bogle, who is the statue behind me. That is a picture from the Vanguard campus. I'm down in beautiful Atlanta, though. And the only reason I chose a non-Vanguard labeled backdrop is because I couldn't figure out how to get the letters correct in the background. So this was my next best choice. So we started the first index fund in the industry. It's the 500 index fund, which many of you may know. And Vanguard has grown to a near $6 trillion asset manager since 1975. We've been engaging the advisor community for about 12 years now. When Vanguard started the financial advisor services business. One reason I'm really proud of that is because I think Vanguard has quickly evolved to a really good partner for advisors. Most of the firms that we are competing with, especially the really classy ones like DFA, have done that for much longer. And so Vanguard's learning. Thankfully, I brought a lot of experience prior to Vanguard into my role to be able to hit the ground running. But Vanguard's learned a lot in engaging the advisor community. And that has led to a tremendous success rate with advisors. Just to give the last point I'll make about our history, many people have thought of Vanguard as a retail direct firm, which we are. We certainly have a significant retail direct business. But if you look at Vanguard's total AUM, again, about $6 trillion, we have about 40% of our assets coming from the advisor community. So it's $2 trillion that is coming from advisors. It is our biggest business and it is our fastest growing business, even though it is one of the youngest businesses at Vanguard. So we're really thankful to all of you who have chosen to partner with Vanguard.
Thank you so much for your answer. So Tim, I'm gonna pose the same question to you, if you don't mind giving us a little bit of history.
Sure, would love to, Wayne. And I'll echo the comments that Steve made. And just really appreciate the time for having us here. Thanks to Steve and Nick for the time as well. And Wayne, Kristen, really appreciate you setting this up, and look forward to the day where we can all get together in person for these meetings soon. So hopefully that'll happen at some point. But I'll try my best, like Steve, to keep it concise and share the the brief history of the firm. But the firm goes back to 1981, so we're about to celebrate our 40th anniversary. But what I would say is the starting of the firm really was born out of some ideas about a decade prior. Our founder, David Booth, was just graduated from the University of Chicago, worked under a professor named Eugene Fama, you may know as a director of our firm and a Nobel laureate. And at that time in 1971, he worked with a number of other gentlemen, including Mac McClown and some others, at a think tank at Wells Fargo, actually developing the first index fund. So there's a lot of commonalities that we have with Vanguard there. And in doing so, they obviously learned a lot, about indexing, learned a lot about the financial services industry. And about 10 years later, decided to go a little bit different direction, but using those academic underpinnings to see, is there a way that we can, create a firm that, has a diversification of an index, can do it in a transparent way, but that could potentially beat the market. And they started that as an institutional-only business and launched the first small cap fund before a small cap index even existed. If you fast forward, 39 years later, we've grown from that one fund to a number of different offerings, over 500 billion in assets across 1,400 employees and 13 global offices. But I think the biggest thing is that we have one overarching investment philosophy that we adhere to. And that's that, markets do a great, incredible job of incorporating all available information into security prices. And that security prices reflect all that available information. And from our research and evidence is that we found it's incredibly difficult to outguess those market prices, but there are ways to systematically invest, based on those decades of theoretical and empirical research, to beat the market without having to outguess it. And that's really been, the underpinning of our philosophy in all our strategies, and one that we continue to today. I'll echo some of the comments around Steve, about working with the advisor community. I'd say that, we're certainly a unique firm in that we only work through a number of approved advisors that we've chosen to, or that have chosen to work with us, and that we've chosen to work with them. And the reason being for that is, we feel as though the advisors that we work with, are the biggest experts in knowing what their clients need and knowing how to manage their, managing their assets. And so, our goal is to support that advisor community as much as we can. And, we do that obviously through investments, but also through messaging and business strategy. So excited to be here today, but just a brief history of our firm there.
So I'm gonna thank you for that answer. That was great. I'm gonna do this a little bit debate style. So since we're in that season, right? So to give
no interruptions though, Wayne. No interruptions.
Right, exactly. To give Steve a chance. I know you spoke a little bit about how you work with advisors, but do you mind going into that a little bit more? That would be helpful to complement in comparison to what Tim just shared.
Absolutely. Yeah, thank you. So again, we've worked with advisors for 12, 13 years now, and that's been quite an evolution as we've determined how to best support the advisor community. The way Vanguard views supporting advisors is we just want to be a provider of building blocks for advisors when it comes to investment solutions. As Tim noted, advisors are advisors usually for a reason. They've studied the business, they've become experts, they are the best arbiters of how to direct client investments. So at Vanguard, we have a wide range of product offerings. I know Nick's going to touch on our active suite, which a lot of people are pretty unfamiliar with. So I'm excited about that part of the discussion. So we want to deliver tools, be it exchange traded funds, be it index mutual funds, be it active mutual funds, be it now private equity. Vanguard has an offering there. Unfortunately, it's not yet available to the advisor community. It's currently only available to our institutional clients. We want to do it in what we believe is the best way, which is low cost. As I'm sure DFA would subscribe to, the best success, the best chance of success that advisors and investors have is to control costs. And even Morningstar has done ample research on that topic, that even, many times cost is actually a better predictor of outperformance than their star rating system. So we go in with the toolbox, think of us as the Home Depot and the advisors as the home contractors. We deliver the tools and let the advisors dictate which way they want to go. And then we provide support based on that. That's on the portfolio level. If we move to just the general market level, we have a lot of content that helps advisors with client engagement. We want to help them create better relationships, more loyal relationships with their clients. So we try to help them figure out a way to deliver value beyond just selecting investments. As many of us know, and probably a lot of people on this call know, because you're dialing in to hear DFA and Vanguard speak, it's very difficult to generate investment alpha. It becomes more difficult by the day, it seems. So we want to make sure advisors figure out ways to bring value beyond just picking investments that try to beat the market. Last component of our support is, I want to be a resource to advisors. I have the luxury of calling on a couple hundred RIAs across the Southeast. I have 13 colleagues calling on thousands of RIAs across the country. So we want to bring resources on practice management to these advisors by bringing them together, sharing ideas that we pick up in the field. So that's the third leg of the way we support. So again, the investment tools in the toolbox, the research that helps advisors have better engagements with clients, and bringing them ideas for better practice management.
That's perfect. I really appreciate that. I'm gonna come back to Tim for the next question, but then I'm going to Nick and Apollo to bring them into this conversation. So Tim, how does your firm view your respective offerings? I mean, I believe, I know obviously you have funds, and I want to say I saw something recent with regard to exchange traded funds, ETFs, if I'm correct. Could you speak to that a little bit? That would be helpful.
Yeah, sure. So yes, we are in the process and have a number of ETFs in filing that are planned to launch at the end of the year. And, one comment, I'll make to that is, we're very excited as a firm. The timing was right for us. And now it's not to say that we didn't like ETFs before, we didn't consider launching them at some point in time, but like anything that we bring out, we think long and hard about, is this going to add value for the advisors that we work with, and more importantly, the clients that they serve. And for a number of years, the demand from the clients wasn't compelling enough for us to launch. And also, we have a very unique process in terms of not only how we think about the financial science behind the premiums that we deliver within the portfolios, but more importantly, how we actually implement that in live portfolios that has a meaningful advantage and end result for the clients. And prior to some ETF regulations evolving over the past couple of years, we just didn't feel as though we could add the value within an ETF wrapper. And since with the regulations changing, and more specifically the ETF rule last year, but basically what it allows us to do is create the flexibility that we've always had within the portfolio management and trading of our mutual funds, and be able to provide that within the wrapper of an ETF. So yes, the short answer is we do plan to launch them. I wouldn't say that we say there's one that's better than the other. It's just based on preference, based on what the advisor thinks is going to make the most sense for their client. And we're really looking forward to supporting both those product lines for the business.
That's great. Thank you for that answer. This is a good segue to Nick to talk about some of the offerings that you all have. And I know Active, as I said, Steve spoke to it. Most people don't know Vanguard with regard to Active. So if you can speak to some of your offerings as well, I'd appreciate it.
Yeah, and thanks, Wayne, for having me, and Tim and Apollo for having this conversation. It's been something we've been excited for a couple of weeks. I would say broadly around Active, firstly, as far as the size of our actual AUM, 25% of our assets are actively managed. Now, this is split between equity and active taxable fixed income, as well as the largest mutual fund municipal franchise in the world. So though, of course, the growth of indexing, the growth of ETFs has certainly made Vanguard one with that part of the conversation, the active one is just as important. And to what Steve mentioned before, whether it's ETFs or funds, or whether it's active versus passive, really the ethos of Jack Bogle wasn't necessarily indexing, it was low cost. And bringing that philosophy into active management is really what's made a lot of those franchises individually kind of successful, arguably just as successful as some of the index products. I would also know around indexing and a fund versus an ETF, I think Vanguard's in a unique perspective because, and this isn't within active, but this is with index product, because we have this proprietary dual share class where the funds are both a mutual fund and an ETF. And I think the history behind this is pretty cool because, Jack Bogle, of course, he wanted investors to focus on the things that they control, whether it be cost, right? Whether it be allocation, but ultimately staying in the market. And, there admittedly was a bit of an internal struggle years ago when we were going to launch ETFs because Jack Bogle was concerned that perhaps they would trade more, this notion that they would trade more than the mutual funds. And in fact, when our economics team and our product team did the research, we didn't really see that. And actually annually, we will do this research on each of the funds. So we'll make sure that the fund is not, the holding periods aren't much different than the ETF, and they're very rarely that much different. So ultimately, to Tim's point, we're indifferent. We think it's a great way to consume an investment product. I think ETFs give us a broader reach, which is really important from Jack's whole mission, 30, 40, 50 years ago when he started out this firm.
Thank you. That's very helpful. I appreciate your response. Apollo, I'm going to bring you into the conversation now. One of the questions that we received was, we've heard much about indexing, and as of late, we've seen a large amount of assets flowing into index funds. What do you say to advisors who feel there will be a reversion to the mean or an eventual exodus out of index strategies to more active management?
Well, I would start by first clarifying these words that are kind of thrown out there: active management, indexing, passive, all this stuff. What does it actually mean? Because even if you look at the different strategies that exist out there, it's not clear what an active and passive is. So let's first delineate what active, the way that we consider active, is stock picking. You basically start with a blank sheet of paper. You try to identify some companies that you think are going to do really well, and you build a fund around stock picking. And that's what we consider to be the traditional Wall Street type of approach. On the other end, you have this idea of indexing. And indexing is basically saying that I'm going to take a list provided by a third-party committee, and I'm going to replicate that list into a fund. And that's going to be called an index fund. So at that point, as a mutual fund manager, I don't have any decision over that list because I'm just licensing it from a third party. So those are the two traditional ways. And what dimensional is somewhere in the middle, because we're not saying that let's license the list. That's where, by the way, I think that we kind of mentioned is that in the beginning, dimensional founders were the very first people to ever create an investable S&P index fund. That was not for retail investors, but for institutions. So they knew all about this, but they also knew the limitations of just, the blinders and just putting only a list together for a fund. So we're kind of in the middle that our goal is to actually beat the market, but not by stock picking. So in that respect, if we delineate in that respect, what I think it's happened is that on the stock picking side, that's where the money is. That's where conventional active management wants to go, because there's a lot of money to be made. The fees on the active funds tend to be a lot higher than on the asset class funds. And because of that, there has been an explosion in professional money management on the active side, the traditional stock picking, to the point where today in the US, there are more professionally managed mutual funds than actual stocks trading on the market. So when you see this idea that the money's flowing from these stock pickers to either Dimensional or Vanguard, it is because it's so competitive. Everybody's looking at the same data. The information flows so quickly to everybody, and it's becoming exceedingly hard for anybody to consistently get a competitive advantage in stock picking and outperform the market. So the question is there something down the road that would make me believe that these active managers, stock pickers, would actually get better at that, so money would go back into theirs? I don't think so. To me, what I see is that this competition will continue to exist. And if anything, we need to have these stock pickers in the market because we need to figure out what the prices are for these securities. On the other hand, right now, I feel there are too many of them. I think that once you're going to start the industry kind of pare down a little bit, then that's going to lead to even more money into these index funds, either Dimensional or Vanguard. But this idea of an asset class fund rather than stock picking. So I don't see at all a reverse of the trend. If anything, a continuation, because it is so hard. And by the way, you've seen the numbers. I think all advisors on the calls have seen the numbers. Roughly about 15% of the stock pickers, after collecting their fees, are able to outperform the market over 15, 20 years. So what it means is that 85% underperform. I don't think that's going to change soon because, again, it's so competitive. Everybody looks at the same data. Everybody has fast information. It's a tug of war. You have, on one hand, 100 MBAs from Stanford, on the other one, 100 MBAs from Harvard, and they're pulling in different directions, and that's not going to change. So I don't see that trend reverting at all. It's this idea of an asset class. So what both Dimensional and Vanguard have in common is the fact that we're both looking at, I'm talking about the Vanguard non-active side, but the Vanguard, asset class is we're looking at broad asset classes that are used in construction of strategic asset allocations. And in that respect, we're similar. And what we're different is that we're not in the business of licensing a third-party list, but our goal is to beat the market. So in that respect, we are active managers, without a doubt. It's just not through stock picking.
Understood. Thank you so much for the answer. And you've earned the title Secretary of Explaining Stuff.
Whoever came up with that was pretty smart.
Nick, you look like you want to say something. And I'm hoping we start to, roll up the sleeves and get dirty. I want some mudslinging in here at some point. This is supposed to be a steel cage match. So Nick, you look like you have a response. So
I completely agree. I particularly around the comments around the size and the amount of active managers and the skill that it takes to beat the market, I think is difficult. I think it's fair to admit that. You know, when we think about disruption, the amount of disruption that's occurring in our industry that allowed active management to get so big was the way that you access not only alpha, but also style premia and beta. And with the invention of index products that are digestible to advisors and retail, you know, we've been really putting active managers' feet to the fire. Is your alpha really alpha? Is it repeatable? Does your philosophy and process make sense? Now, I would say from our perspective, we are the largest adopters of the sub-advisor model in the equity space. We work with 24 external partners, but we comb a universe of tens of thousands of active managers. Like Apollo mentioned, more active managers than there are stocks. And we come up with a list of or firms that we work with that really do have this repeatable alpha. And I can assure you it's out there, but it's also more difficult, I think, than to say that a good portion of them can consistently outperform. And I mean the tens of thousands. And when you do find those ones that have that skill, those great investors, the great firm, the great process and the philosophy that actually translates into durable alpha, we can partner with them and bring them on to work with one of our funds. And then of course, kind of adopt our vehicle structure, which is lower cost. So on the active side, it's a combination of talent, which to Apollo's point, I agree, it's a difficult game to play. But by being objective and bringing the best of the best in-house to work on behalf of Vanguard shareholders and combine it with Jack Bogle's kind of belief that low-cost investing is really, you know, one of the only free lunches, if you will, when it comes to making a decision, it tends to be a pretty good type of combination for active equity investing for our particular kind of world.
That makes sense. No, that's very helpful. So I'm gonna pose the next question, which sort of piggybacks on something that you both Nick and Apollo mentioned. I'm gonna throw this first to Tim, and then we'll go to Steve. The question's about cost. And it basically says, similar to the way trading costs ultimately have found its way to zero, what do you envision happening to the underlying costs of both index and mutual funds? And how is your firm positioning themselves to add value with this in mind? So Tim, we'll start with you.
Yeah, it's a great question, Wayne. And if you look at the last decade especially, I mean, the trend you've seen is obviously downwards. Fee compression in terms of trading costs of custodians, in terms of commissions, obviously with more advisors moving to a fee-based advisory role, and also in expense ratios of funds. Give a lot of credit to Vanguard. Obviously, they are one of the lowest when it comes to expense ratios. But if you look at the industry, I think that trend will continue. You see that at Dimensional as well. If you look at across the board in every single asset class, we're in the bottom decile of the Morningstar category. And we've seen, over the last 5 years, and 3 of those past 5 years, we've actually lowered the expense ratios on a number of our funds, including this past year, lowering it pretty much across the board. And then we just published the expense ratio on our ETFs, and those have come in pretty low as well. One thing I'll say on that is, cost is extremely important. And I think to Nick's point, it is one of the free lunches out there, and we believe diversification is another one of those free lunches out there. But, cost is only a bigger issue in the absence of value. And, and what I would say is we wouldn't have a business if we didn't have the ability to beat indexes. And, Paul mentioned before around, the industry, if you look at the difficulty in terms of outguessing markets, with active managers having that history, I believe 15 or 17% over the past 20 years. If you look at Dimensional during that time, of the funds we've had in existence over those same 20 years, 81% of them have outperformed. And I think more importantly too, 100% of those funds still exist. That's something that's still kind of overlooked in the data a lot when you look at active managers. Is not only that 17% have outperformed, but of those 17%, there's only about a 40% survivorship over that 20 years. And it's a lot of those high cost type or underperforming funds that have gone by the wayside. So, we do see fee compression continuing. Cost is extremely important to us, but it's one of many things in terms of, the dimensions of return, in terms of trading, in terms of portfolio construction, that all go into what's the end investor experience and the total return that we're getting net of fees.
No, that's helpful. Steve, I'm sorry. Go ahead.
Sure, I'll piggyback on that. Thank you. So we say, look, low cost is in our DNA. And I remember when I interviewed at Vanguard back in 2011, when I would ask, or is Vanguard just the index firm? And they say, no, we're not. We're not the index firm. We're not the active firm. We're just the low cost firm. And your question said, how are we positioning ourselves? We've already done that. And as Tim nicely acknowledged, we've been a disruptor in the industry to put a lot of pressure on managers to lower their fees because there has been such a significant drag in performance. So we'll continue to do that. That will continue to be in our DNA. We're the only mutually owned investment company in the industry, meaning that ultimately the shareholders of our funds own Vanguard. So all of our decisions are fully aligned with the end investors. There's no other entity who we have to satisfy with a certain profit margin. No public shareholders who we have to satisfy with a profit margin. So it's a simple model. As assets grow, you'll continue to see costs go down. One thing I would point out real quickly is, this race to zero, right? There was so much buzz about that, maybe 2 years ago, I think now. It's hard to estimate, since the last 6 months, it felt like 2 years. We think that whole loss leader model, where a bunch of fund companies are going to just throw out a bunch of zero expense ratio funds, is not, we just don't think that's realistic. We don't see how anybody can build a business on that model. So you've certainly noticed a decrease in that kind of news. So, it just generally feels like to us that things are leveling off now. But you'll continue to see us lower our expense ratios. One thing that I will lastly note is, I mentioned as assets grow, you'll see expenses come down at Vanguard, because we're simply spreading the cost, ultimately the fixed costs, over a wider asset base. In the last 12 months, this is the first time where we've seen the expense ratios on our ETF shares diverge from the expense ratio on their respective index fund shares. Not in every case, but some cases. And the reason for that simply is the growth in the ETF assets has been more robust than the growth in the mutual fund asset base. So, just another example there of how we're positioning ourselves to continue to lower cost in this industry and remain competitive and relevant.
Wayne, can I add something to what Steve
Please.
and I think that it's an interesting point that Steve, there's this race to the bottom of fees, and everybody's going in that bandwagon because there's competition, all that, and there's no doubt scale matters. The larger you get, and it's kind of the same that Tim mentioned and Steve. As we get bigger, we all get bigger. We want to do what's right for clients. These fees would get lower. But there are two comments that I would make on that. The first one is that I've always been a believer that it is not about the fee itself; it's the value. Because none of us actually shop for the cheapest dentist in town. I hope not. We're not going to the car lot and say, show me your cheapest car. You want to have good value. You don't want to overpay, but you have to look and see, if this is a little bit more, am I getting enough value for the, a few basis points more than you might be paying for a fund? Now, if you totally overpaid, then the value has to be so significant that at some point it gets wiped out. So I would caution, because as much as fees matter, absolutely costs matter, it's value that counts. It's value, not necessarily just the bottom of the fees. And as you see some of these funds going to zero, what I think is going to happen is they're going to get more creative into how they make money. And a good example of this is if you look within a fund, and that's something that I'm familiar with at Dimensional, there's something called securities lending, where the actual stocks in the portfolio are being lent. And for that, the fund generates income, generates revenue. And that revenue, for example, you can have a fund that has zero fees, that doesn't charge anything, but they get to keep the revenue. And sometimes that revenue might actually be more than what the fund could charge. In our case, we're saying, okay, well, here's a fee, and then we also give back the shareholders the revenue from the sec lending. And at that point, if you look at the balance of, okay, what's the fee, what's the revenue from sec lending, in a way, a lot of times you can go through the disclosures and the financials financials, and you can see that they're actually remarkable what seg lending can do. So we could say, hey, there's a zero cost fund. We just get to keep the seg lending, but that's not that's disingenuous. So I think part of the idea of costs is that you have to make money somewhere. You have to make money. And whenever somebody says it doesn't cost anything, you're probably paying too much. So it is important to distinguish between value, but also understand that at some point, somebody makes money somewhere. And the more transparent they are, probably the better off for you as an advisor.
Fair point and great answer.
Wayne, I'll quickly add, since
Yes.
Apollo mentioned
Please.
the sec lending, that was a really good point there. Vanguard adopts the same model where we return all that revenue to the investors. So we totally agree with that sentiment.
Thank you for sharing that. That's a great point. There was a comment that while we were just doing that. This is from Brandon Mackey. It says, my understanding is that fund fee compression / transaction charges are offset by larger spreads and order flow. Am I wrong? Steve.
So I think I'll defer to Nick on that because that's a little more of a
Sure.
technical discussion there. I'm going to defer to Nick there.
Yeah, I mean, I think from our perspective, I would say that that's not really where we're offsetting. To Steve's point, it's more or less scale, and scale is what's going to afford us the ability to really drive costs down. The other lever, obviously, is going to be the fund's own trading activity, and there are various kind of policies within our own funds. Like, for instance, whether we use a multi-manager structure in an active equity fund where we're not hard and fast rebalancing the portfolio to frequently turn it over, or same rules would apply for a target date fund. So making sure our own internal rules kind of allow trading activity to be particularly light, combining with that, entering into markets where we can provide market cap exposure, but ultimately where we can drive scale. Right, and that's what you'll see a lot of Vanguard exposure. It isn't a coincidence that I think that we're looking not necessarily for the next $100 billion idea, but it's important to us to deliver an idea that can be democratized to some degree and highly adopted, because then ultimately it turns out to be lower fees for our investors. So I would say the transaction fees, it probably arguably might collectively go down as a percentage of assets as that occurs. But there are certain kind of standards we hold ourselves to make sure that we're doing so, if that makes sense and answers your question.
That does make sense. That does make sense.
And
Go ahead, Tim. I'm sorry.
And, one point to that too, I think, especially with the impending launch of our ETFs, and it's good to have Nick on the call here, because we actually were colleagues together a number of years ago at BlackRock. So we talked about this a number of times, but it's important if you're an advisor, doing the due diligence for your clients, to think, when you think of costs, there's explicit costs and there's implicit costs. So, the expense ratio is just one cost. You should be mindful of, spreads and looking at those different things that go into it, because that can impact the total cost of the investment. I love Nick's point around being, low turnover. That's one thing that we're really keenly aware of, is the turnover in our portfolios. And if you look at the core portfolios, they're single digit turnover. So, we're being really mindful of those trading costs that go into it. And it's going to be the same when it comes to the ETFs as well. But it is something to be wary of, especially when you're trading ETFs, is to think about, there are those expense ratios that you see, but there's also, the underlying fees that you don't see when it comes to trading costs.
But the question, I think the question that Mackie had was more about, are the fees that the mutual fund charges getting lower because of these larger spreads? And the answer is absolutely not, because the way that a mutual fund, whether it's Vanguard or Dimensional, the way that we get paid is through a management fee that's clearly disclosed. We don't get paid because of order flow. That's what Robinhood does. God bless them, but that's not what we're doing. So it has nothing to do. The trading costs come out of the returns, but they don't go in the pocket of Dimensional, not at all. It's a cost incurred to investors. It has nothing to do with the management fee that Vanguard or Dimensional would charge to handle your money.
Good, thank you. That's great. We're gonna shift to the topic of the day, which everyone has asked about. So this is the growth versus value section. So like Nick, I'm going to take a drink before we get started. Because growth and value is a topic du jour. Everybody talks about growth and value. So this question comes from Terry Ford. It says, should we still believe in basically mean reversion for value, or has something fundamentally changed? And since Apollo last spoke, we'll start with you, Nick.
Yeah, and the good news is we've certainly got plenty of reps here, and I would tag it at the billion, trillion, whatever dollar amount question. It's important though, and it's not only questions that we're getting from our investors or people who invest with Vanguard, but it's the question that I ask when our sub-advisors come to Malvern. And I think the really kind of unique perspective that the sub-advisor model affords, me selfishly, but also as I share it with you, is the range of views. What we hear from a lot of our quantitative managers is that not only is mean reversion still a thing, but it's really a bedrock of financial investing. And historically, the value premium has outperformed over long periods of time. That doesn't necessarily mean it's going to outperform all the time. So I think this period for quantitative managers whom we work with has been particularly challenging for a unique reason. And I think in '99, the TMT bubble was obviously the magnitude of that spread and not as much the duration. I think post-global financial crisis, yes, the magnitude has been, it's been large. It depends what metric you're looking at. It hasn't been as large as the dot-com crisis, but the duration has been notably longer. So a lot of the quantitative managers that we work with call it a slower moving, less exciting type of environment compared to what we saw with the last type of growth value dispersion. And I think the most important part of that is that they would define it as far as a reason why, right? These things don't just happen coincidentally, is that there's this, in '99, you had capital chasing no earnings, companies that had a pitch deck and 3 employees and maybe a keg and a dog. In 2020, these companies are huge and they're making money. They have free cash flow. They can fund their own growth. And a lot of investors are looking for the next fangs. It's creating capital to be over patient, which has really allowed this value dislocation to occur for a really long time. On the fundamental side, I think you start to see some nuance, right? This is where you're going to see investors mention things like, you can't still utilize PE exclusively. You can't utilize price to book exclusively. So the example we hear a lot from Wellington, one of our largest sub-advised partners, is like shopping REITs, right? Which are most notably going to be priced very attractive, but so much capital has flowed out of that sector that the amount of money they need to put into the business to get the same return on the ROEs or ROICs that they got just last year is higher. And that's a tough business. So the active fundamental investors are kind of duly tasked now with not just finding cheap stocks, but then parsing that with, is this a price dislocation, or am I getting in the way of an industry or stock that really has no turnaround story and could potentially be getting disruptive? So the job is arguably getting harder, I think, for fundamental investors. But I think they're looking at it a little bit more differently than some of our pure quantitative investors are.
Thank you. Apollo, I'd love to hear your thoughts.
So my thoughts, I'll just start with the unequivocal answer is that there's nothing wrong with value. In fact, I'm actually really proud of the way value has performed. I know it sounds kind of crazy because it has underperformed growth, and people are looking as, it's like, well, value's underperforming growth. How can you possibly say something like that? Well, I mean, it's to me, like, if you look at the data, it's really, really simple to understand. Value has delivered, at least looking through the end of last year. This year, again, hasn't been that pretty, but if you look at the end of last year, value for the past 10 years has delivered pretty much the long-term average returns of the asset class. So there's nothing to be ashamed of getting the long-term average returns. It was a little bit under 12%. The problem is that growth large growth in particular has shut the lights out and is just way out of its league in terms of returns. So it's not that values is doing poorly. It's just that large growth is an anomaly. It's an anomaly, and particularly the last 3 years, is not the last decade. The last 3 years, large growth has done tremendously well, more than twice the historical average. So my question to everybody is, what are you more afraid of? An asset class that has delivered the long-term average returns, or an asset class that it's way out of its league with twice the average returns that historically see? So I'm not at all concerned about value. What I think you got to be careful is that these large growth companies, they have had a great run, but they have become incredibly expensive. To buy $1 of earnings from Amazon, it's going to cost you $100+ for $1 of earnings. To get the same dollar for Pfizer or Intel, it's $10 to $15. So the valuations right now are so high that it's kind of harder for me to make a case, go put more money in large growth. They've had a great run, great, but be careful, because that's exactly what we saw in the 90s. And more so, I think that Nick mentioned this. This is not about certainty or guarantees. This is about looking at the data and an evidence from more of an institutional approach that relies more on statistics and probabilities and managing odds rather than certainty. In fact, Wayne, if any of us quits smoking and eats healthy and works out, it doesn't guarantee a longer lasting, healthier life. What it does is improves the odds. So when you look at the odds, historically, absolutely without any doubt, whether you look at 1 year, 3 years, 5 years, value has outperformed growth, but not in every case. On a 1 year basis is roughly about 60% of the time. You go to 5 years, it's about 2/3 of the time, but it doesn't mean that it's every day. And to me, the worst thing that you can do as an investor is to change strategy because the last couple of years haven't worked out. I mean, it was crazy because one of my friends, we had this conversation in about a year and a half ago that stuck with me. We went to Vegas and none of us were like experts in blackjack, but we went to the table and we wanted to know, okay, so if I have 13, the dealer has a 10, should I hit or should I stay? And we're kind of discussed and talked to other people. And wait, I don't know if you're an expert at this, but what should you do if you have a 13 in your hand and the dealer has a 10? Are you an expert?
I'm not an expert, but I'm gonna hit.
Tell you what, the people I talked, they all kind of said, you should hit because you're a lot better odds than if you stay. So let's just agree, not an expert, let's just agree that you should hit. The thing is that what if you played 4 hands on that strategy and you busted? Should you play your next hand any differently? And the answer is no. The people who get in trouble are just, well, it didn't work out the last one, let me try something else. The odds haven't changed. I still 100% believe that value will do better than growth. And I'll close up. If value doesn't work anymore, we have a lot bigger issues in our society, because value basically means that the people with a low FICO score are going to pay a higher interest rate. That's what the market's telling you, that these value companies have a lower FICO score and they have to give investors a higher return. If that premise is not there anymore, well, a lot of other things in society won't work. I mean, we all expect that if you go to college, you should have a better salary and you should make a better living than if you don't. Of course, you can find example of people who don't, but that's the expectation that we have. Every single day, I expect that value is going to do better. When you show up at a ski resort in January, you expect to see snow, but if it's not there any one year, you don't change your expectations. So for that matter, I'm 100% comfortable with value. I'm a lot more wary of growth because that's what I think is the anomaly, not value.
I might add to some of that, if I might, Wayne.
Please.
And I think it's all really strong points. And from Vanguard's perspective, when we look out over the next 10 years, we run our capital market outlook, and we most certainly have value outperforming growth. And it's using the empirical data that, I think to some degree that DFA references and uses as well in their portfolio positioning, right? Very thoughtful approach to their tilts. When I have these conversations with clients, and we like to talk about things like mean reversion. We like to talk about things like value premia and certain spreads. But, perhaps as the history buff, or even a short-term history buff in me says, is really drop in the context around what we've seen over the last 10 or 12 years, right? 0 interest rates, $4 trillion originally Fed balance sheet, which went systemic really to all all financial institutions are all around the world, or monetary policy around the world. And then now, of course, with COVID and having a $7-8 trillion balance sheet, a lot of fiscal spending and low rates for a long period of time. Over the history of financial markets, there has never been a time or a period like this. There has never been so much intervention to any degree, let alone $8-9 trillion of degree in 0% interest rates. This isn't the late 1980s when the Fed raised rates too quickly, or maybe they eased a little too much. This is a behemoth of monetary policy, and it is by conventional measures, it's been abnormal. And to expect normal market prices during such a long period of time, I think it would be a bit confusing. Not necessarily sounding the alarm bell, but I do think there are reasons why, again, coming back to the quant investor that we work with typically, who investors, he believes investors are being over patient in growth because they can be, because rates are so low, because the Fed has the printing press out. So the historical context around these gaps and these figures and this mean reversion, I think, is really important. And I think it will really help drive why this has happened and why it's taken so long, perhaps, to see the type of performance and the type of returns we've seen in the past.
Great, really, really helpful information. So we have, I don't know, about 7 minutes left. I have a number of questions. I'm going to try to consolidate where I can and sort of pick questions that I think our audience would like to hear most. And one that comes to mind is this question that I'm seeing here: with bond yields so low, what offerings do Vanguard and DFA have for clients that would provide, I guess, income? The focus obviously on income or search for yield. I'll turn to Tim and Apollo first, since Nick last spoke.
Yeah, no, it is challenging, right? The interest rates are so low, and whenever you have interest rates this low, I think that you have to look and see that it's not universally bad or good. It just depends on who you are. If you are a borrower, those interest rates, the low interest rate, are really helping you, and in fact, a lot of the companies in the stock market are being helped. If you're a saver, that doesn't help you very much, particularly if you want to generate income. And that kind of leads to the big question: is what is the purpose of having fixed income that is tied to these interest rates in your portfolio? And there are different ways and different reasons that people have fixed income, and perhaps one of them is to generate income. What we find is among advisors, sophisticated advisors, generally that's not the primary reason. Because you can generate income in a much more sophisticated way than just plopping the money into bond funds or individual bonds and saying, I'm done, I'll just generate income. I think that's a very simplistic and quite often naive, but for some individuals that seems pretty good. I'm just eating principal, I'm eating interest, not my principal, where in fact it is very risky as the rates change. The reinvestment of those bonds could actually lead to different yields. But in this low interest environment, if you're using bonds just for that purpose, well, in that case, yeah, it's a challenging time. The way we look at it at Dimensional is that you have to look at a total portfolio, and you have to see, okay, the low rates might not get you much in the bond market, but they might help the stock market. So in that respect, having a total perspective is more beneficial than trying to get and say, well, I need to get the yield from that fund, and that's what I'm going to live on. The last point that I will make is that when you look at the total portfolio, which I think it's a better way to do it. Most people, as they get close to retirement, you can generate a higher level of income per unit of assets through this total return than to just look at just the yield. So we don't have like a strategy that says, okay, here, buy this fund and that's going to generate you that income and you can live happily ever after, because that's not really the most sophisticated way. And what advisors we work with, we help them design strategies to actually do an asset allocation and generate income. And if for people who do want a one-stop shop, we have actually target date funds that are not built around accumulation, but creating income. So if somebody does want that, we do it. But again, it's a mix between stocks and bonds rather than putting all the money in a bond fund. That's not effective. So if somebody wants, we actually have specifically designed funds for people to generate income. They're called target date income funds. And the goal is not let's accumulate, let's generate income. And we have that. But we think that it's the advisor building an allocation that it has both stocks, bonds, international, US. That's a better option than just, looking for like, what's the yield on that? That's pretty simplistic.
And Steve or Nick, would you like to?
Yeah, no, I think those are all really great points. And we think of fixed income very similarly, right? And whether it's on our active franchise, although we very much believe in credit research and the ability to generate alpha with credit, we will keep our duration bets relatively in line with the benchmark. And the reason why is because we want to hold a duration that is benchmark-like to provide ballast if bad things do occur. And we really saw this unfold in Q1 of 2020. The fixed income trade post GFC was short duration, long credit. And a lot of competitors really rode spreads down for a long time and, arguably had great performance up into that period in which you have a severe liquidity crisis. And at that point, you have ultra short-term bond funds that are down 3%. Duration is your friend. It provides ballast. And not only will it perform well in those market periods, but it also can provide liquidity and allow you to be a buyer of risk when everybody else is going to be a seller. So when we think about the core principles of fixed income, that's going to be just as important as yield. I don't want to completely dismiss it. I think it's important, but the main reason should really be viewed as ballast. And that's how we run money actively at Vanguard. I would also note that in the context of the conversation of the 60-40 portfolio, and when this really came out in the 1950s, right? And Harry Markowitz, looking at the return and volatility of certain asset class and what's the optimal blend of stocks and bonds and other asset classes. Although in my previous answer, I talk about maybe perhaps low rates being a catalyst for overpatient growth capital, we never talk about the benefit of low rates on fixed income for investors seeking balance. In 1950s, when they had the 60-40 portfolio, the 10-year was probably 5% and the duration of the ag was probably 4. To get that same portfolio duration in the context of a entire equity bond stock, you would need less of a risk-free rate because although your yield's smaller, your duration is getting extended. And that's going to allow you to buy other income-producing asset classes. So whether it be things like dividend yield or other parts, more attractive parts of the fixed income market that have spread like ABS or MBS, other agency debt, that's what it frees up your portfolio to do. So I think you don't have to tether your portfolio to 60-40 and still reap the same benefits of duration that you got when rates were notably higher. So it's not all bad when rates go down.
No,
Part of the reason, Wayne,
Yeah.
part of the reason that the rates are so low is because inflation is so low. So if you look historically, you can go in the 80s and you got paid 15% on bonds, but who cares because inflation was roughly the same. So when you look on a real basis right now, it's not, terrible. And when you talk about like what Nick and I were saying about the bonds as being a volatility dampener against stock market drops, they have done their job. Even this year, you look at the end of April, the stock market was down, the bond index, the government bond index was up, and it's been the case like that for the past 20 years every time the market drops. So they are doing their job, even if low interest rate environment.
It's a really difficult conversation to have, even with myself as I allocate my own portfolio, because there's no tangible return or yield that I'm going to see when I talk about the ability to be a buyer when others are sellers. And I can't underscore how important that was to our active fixed income franchise. We came into this year believing that trendline growth is going to be lower, certainly not predicting COVID. But because of that, it allowed us to buy risk again when others were selling. And so we not only performed well when things were going poorly, but we were also able to participate more so on the upside. And it's difficult to really crystallize. It's not necessarily tangible when you're positioning, but it's extremely, extremely powerful in periods like that. And frankly, I guess even more broadly, it's rebalancing in its simplest form. And we know, like low cost, it's just a very powerful tool that's probably underappreciated by like the most sophisticated investors. It's a great way to really position your portfolio to be on the front foot if things do go haywire.
So, gentlemen, fantastic. We're 3 minutes past, and honestly, I can stay and do this all night. I have a drink. I'm not sure if everybody else does, so I can stay. But I want to turn it over to Kristen to close us out. I really appreciate your time. Really appreciate your answers. This was fantastic.
Yeah, thank you everybody for joining us. This was amazing, and wow, thank you. I just can't even. This was great. I just thank you for all of our esteemed panel, Steve, Apollo, Tim, and Nick. And thank you to members and guests that decided to join us on a 4:30 on a Friday. So, wow. Awesome. Thank you all. And
Kristen,
go
I
ahead.
would just add, if anyone has any follow-up questions that come to you,
Yeah.
feel free to relay them. We'll respond accordingly.
Absolutely.
Thanks so much.
Absolutely. Yeah. Thank you. That's a great reminder. Thanks, Steve. Yeah. And anybody, you've got our email to let us know. Esther said, thank you. Great job, panelists. So everybody,
Yes.
thank you. Thank you.
Thank you all. Have
All
a
right.
great holiday weekend. Everybody
Have a
stay
great
safe.
weekend.
Take
Thank
care.
you. Take care.
Bye.
Have a good weekend.
Bye-bye.